Everybody get up!
And welcome back this morning. I'm your host, Lance Roberts. It's 6:33 on The Real Investment Show. Michael Lebowitz, CFA, joining me this morning. So we're just talking a little bit about this idea that because of the debts, because of the deficits, because of this abuse, really, of economic theory. And again, you know, we're talking about modern monetary theory here, but look, we've abused Keynesian economic theory for the last 40 years. And that's why we are in the hole that we're in now, because we didn't really work the theory the way it was supposed to work. We just latched onto the one part that says, if you have trouble, spend more money on debt and then everything will be fine. It's never really worked out that way. Slower economic growth, weaker wage growth, widening wealth gap, economic prosperity has been weak for 80% of Americans. But, you know, you just wrote a very interesting article about, which is on the website right now, about this idea about the fingerprints that are on the markets and really in a lot of ways on the economy as well, you know, and you know, this idea of slower growth and then what we're paying for things, particularly in the markets. And Apple is a good example of that. And we talked about Apple this morning on the show a little bit. You know, we were talking about selling and taking profits out of our tech stocks last week. You know, that's been a good trade so far. A lot of those have started to correct here a bit. But, you know, there's a real hurdle here. You know, people are paying a tremendous amount of money in terms of every dollar of revenue these companies generate on the expectation that this is going to continue into the future. But that may not be the case.
No, and I think Apple and Microsoft are good examples, right? Companies like Netflix or Tesla or Amazon, you can make a story that they're going to grow significantly in the future. Whether we believe the story or not is irrelevant, but Tesla can grow in the future. Mm-hmm. Amazon can grow significantly in the future. Apple and Microsoft are much more utilities, and their revenues have really flattened out over the last 5 years. So you're buying great companies. Don't get me wrong. They are great companies with great products, but their revenues have been relatively flat, sort of like utilities. They grow at basically the economic rate. So if we just look at Apple stock is up about 20% from where it was before COVID started, let's say late January, early February. So you have to pay a 20% premium in price to what you had to pay in late January. Now, at the same time, we are in a recession, a bad recession, and we will be in a recession for a while, and economic growth is not going to the rate of economic activity will not get back to where it was for, at a minimum, 3, 4, 5 years, right? Meaning that Apple sales will not get back to where they were, barring any new models, everything being equal, and that's an assumption here, everything being equal, their sales are going to follow the economy to a large degree. They're very well correlated. So then it's how we ended the last segment, right? Well, because of all this debt, economic growth will necessarily be lower than it would have been had we not had this recession.
Right.
So we have this trough in the economy, right? And we have a slower growth rate coming out as we recover than we would have. So there's going to be less economic growth for not just until we recover, but for the foreseeable future. So now you look back at Apple, right? You're paying 20% more and you will be getting less in revenue, less in earnings. So why? And to be fair, Apple was expensive before COVID. Right? You were paying a lot for what's basically a steady earning utility stock. Again, a great company, but you're paying a lot for it. Now you're paying 20% more, paying more for less.
This is an important point because we're seeing this in a lot of stocks. We wrote an article recently talking about the number of companies that are trading at 10 times price to sales.
Right.
And that requires a tremendous growth rate. But there's stocks that we have currently trading at 20 and 35 times sales, which is an infinite growth rate for these companies that they will never be able to achieve. Just even in the best of circumstances, they'll never achieve that growth rate. But yet, investors are paying this and then trying to rationalize overpaying for things now, saying, oh, well, yeah, but in 2 years, the earnings will be better, so I'm going to pay for it today. But that's like buying a $500,000 house in a $250,000 neighborhood that'll be worth $500,000 2 years from now. you don't make any money that way. And that's really the key point here.
No, the key point is, look, you can buy that $500,000 house if you think you can sell it for $550,000 to someone else in the next week or two, but know that it's worth $250,000. And look, we own Apple. We've been taking some profits. We know what we're getting into. We're by definition value investors, right? But this market is forcing us into some of these high growth stocks. And we know that these are trading positions, not necessarily long-term positions, because we're paying an awful lot for them. So why are we doing this, and why are so many investors doing it? Because passive investing, the passive strategies are the new thing, right? So there's passive and active. Active means that you go comb through financial statements and you find companies that are really cheap, that have that you're paying a very low premium for revenues, for earnings. They have the potential for good growth, and you're just getting, you're buying that $100,000 house on the $250,000 block. And then there's passive investing, which says, I don't care. I just want to buy the block. I'm going to buy the whole block. I don't care what any house is worth. I just want to own the block. Right. And in that block, there's the $100,000 house and the $500,000 house and everything in between. The problem is the way these indexes are constructed is they're market weight, they're size weighted. So in other words, when you buy, and we wrote about this in the article, when you buy the S&P 500, if you're buying $100 worth, you're buying about $6+ worth of Microsoft and about a penny worth of Xerox. So you go to market and you buy, your $6 worth of Microsoft. That has a bigger effect on price than your penny of Xerox. So what happens? The Microsoft's price goes up a little bit. Xerox goes nowhere. Now Microsoft has even a bigger market cap. It's even bigger. Market cap is just the price of the company times the number of shares. So now the next guy, so Lance comes in after me, and he has to buy 6.1 of Microsoft for every penny of Xerox. And this becomes very circular. Right. Now you may ask, okay, well, at some point, doesn't Microsoft become, right, if you take it to its natural end, which could never happen, but if you do, Microsoft is worth 98 cents on the dollar, and everything else is worth 2 cents on the dollar. Right. The problem is it works in reverse just as easily. If I have to sell my position because I need cash, because I'm scared of the market, because the market falls, because of any number of reasons, I have to sell my $6 of Microsoft, but I only have to sell one share of Xerox, one penny worth of Xerox. Right.
And that's kind of what we saw back in March during the decline. One of the reasons that the sell-off in March was so dramatic, and you had a 35% decline over the course of a couple of weeks, was a lot of this, because when we saw when that started happening, people were dumping ETFs, they were dumping stocks, and we had warned about this over the last couple of years. We'd written articles saying, hey, when somebody yells fire in the theater, it's going to be very, very fast on the exit, because as people sell the ETFs, that also forces the sell of the individual stocks. And if people are selling the individual stocks as well, that's also dragging down the price of the ETFs, which is now forcing more people to sell the ETFs. And we saw that just, markets were down, on the Dow, 1,000, 1,500, 2,000 points in a day, just phenomenal daily moves in the market as people were literally just liquidating everything they had. But that's part, as you said, the passive indexing thing boosts markets on the way up, but it also evaporates markets on the way down.
Right. And maybe we can talk a little bit about this, passive hedging, right? A lot of investors were spared some of the pain, definitely in 2008 and 2000, and even in March, because they own bonds. Right. And bonds did really well, so they were spared the pain. If that happens again, what we saw in March, they're not going to be spared any pain, because yields have very, very little to go lower. Right. And that's going to be, if the market's down 30% and you're down 15%, you say, okay, this isn't so bad. I can hang in there. Maybe I'll even buy here at the lows. Right. Right. But if the market's down 30% and you're down 30%, it's a different attitude you may have, and you may react by, and we see this frequently at market bottoms. Retail investors start selling when they should be buying because they're panicking.
Well, and it's interesting, one thing that we've done over the course of the last decade is that we've trained investors that whenever the Fed steps in to start providing liquidity, then everybody runs and starts buying stocks, because it's kind of like Pavlov's bell. The Fed rings the bell, investors buy stocks. And now it seems that the Fed is now trapped in every single situation to where if you have even a minor decline in the markets, they're going to try to come in with QE to help support asset prices. So, the problem on both the bond side of the portfolio as well as the equity side of the portfolio is that you have no price discovery. And it's at some point, the Fed's going to step in with liquidity and it's not going to work. And then investors are going to really be toasted. So quick break. Quick break, though. We're going to come back. We'll finish up with that thought. Michael Lebowitz right here on The Real Investment Show. Don't go away.
Edge of the world and our Western civilization. The sun may rise in the east, at least it settles in a final location. It's understood that Hollywood sells Californication.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.